Good morning and welcome back, everyone, to the Schwab YouTube coaching channel. It's the Thursday edition of Trader Talk in today's market, and I'm your host, Kevin Horner, joining you from the comfort of my studio here at home in Denver. And I am pleased this morning to be joined in the chat by my friend and fellow coach there, Ben Watson. Say hey to Ben, everybody in chat. Make sure you're following us on X, Ben Watson CS, Kevin Horner CS. Today, we are going to have a review of the markets, of course. Looks like we might be getting a little bit of a bounce in some of those interesting areas that you all like watching. We're getting a little bit of perhaps bounces at important areas of potential support. So, undergoing pullbacks is never fun, but we might be in the midst of validating some areas of support for some interesting segments and industry groups in the marketplace here. So, as always, plenty to get to. Additionally, I was on with Brent Morris yesterday. We had an opportunity for a survey, and I had a lot of requests to kind of dive a little deeper into process. And so, being that it's a solo show for you all today, I thought we would expand on some of that process a little bit. Try and provide some of you with some additional context and color to how you might look at your mornings, how you might start the day, how you might evaluate relative strength, and so forth. So I do always try to bring what I can in the way of responses to survey questions. So today we'll probably touch on a few of those key points in effort to answer some of those requests. So with that, let us jump to our disclosures so that we can move to the charts, which will start, of course, with the S&P 500. So first of all, remember that everything we discuss today should be considered informational and educational exclusively. We do not make recommendations here. We do not endorse any specific approach to trading. What we do offer up is insights, education, knowledge of technical analysis. The extent to which you utilize that technical analysis, of course, is your decision. So please do your due diligence, know what matters for you, and of course, try to adhere to a plan as best you can. One of the things we know about trading is that consistency will reward the trader over the time frame that they are active. So building in a process, sticking to it, and being disciplined to it is hard, but it is important. So try and build that process out here, utilizing maybe some of these thoughts and insights that we try to provide here generically. Now, the other note as it relates to technical analysis, though, is that it's not the end-all, be-all for decision making. So it can be a part of your process. Obviously, it can help you decide when to be a bit more invested, or maybe when to be a bit more in cash. But by no means is it the extent of everything. So you can make it a part of your decision making, but not the entirety of your decision making. And with that, in terms of an agenda, we work top down. So we will hit the big three: the S&P 500. The NASDAQ 100, the Russell 2000. We'll talk briefly about semis, more in sectors and industry groups today, though, as we'll have a little bit more time. So with that, let's talk about the S&P, because we've been talking about, of course, the consolidation going on in here. I've drawn in what looks a bit like a pennant, a long-range pennant, that is. Anybody else encouraged by what we got yesterday? We had an open yesterday that was okay, but we sold down pretty quickly down to the 50-day moving average. But for those of you who are looking for validation of support, you might be enthused by yesterday's hammer candle, a bounce right off the 50-day. If we went exclusively with the 50 and took off the 20, it'll appear a little more clean here. But you can see a lovely bounce right off the 50-day. There's also a ledge of horizontal support through here, providing a little extra confluence, and we bounced right back through it there today. So we are into our downtrending line. We had a little bit of a head fake in there, right? We tried to break out on Monday, it didn't hold. Throw back to the trend line, to the 50-day. So if nothing else, bullish traders here maybe feel a little more confident about management of risk relative to the 50-day, which is to say, under the 50-day, they may get a bit more defensive. Remember, the choice to sell some S&P 500 positioning or reduce position size is each of our part of our process individually, right? However, The way to be thoughtful about this as to whether you should do so, whether you take steps to reduce position size or not, is probably based on a day closing below the 50-day, or maybe a series of closes below the 50-day. The reason I say that is that if we go and I'm going to clean all this up once more. I'll just remove my drawing set here. We had 1 day below the 50-day right here, right? And if you were seller because you had a day below the 50-day, you might not be as happy about it today, right? You took some off. If you put it right back on the very next day, you're probably okay. But if you took it off just based on the fact that we were 1 day below the 50-day, you might think, okay, maybe I need to evaluate my process a little more. One other consideration, did I get a second day below the 50-day? In this instance, no, right? We got right back above the 50-day moving average. Some traders look at that as just, okay, we're back on trend. The other scenario here to be aware of is while we made that low below the 50-day and closed below the 50-day, feeling a little weak, a little uncomfortable, what we did not do was make a lower low, right? We didn't even make a matching low. So if you're looking for an additional reason for defensive posturing on a single day closing below the 50-day, you really didn't have a whole lot of good reasons for reducing position size other than perhaps your own discomfort. And then the question becomes, if I'm uncomfortable below the 50-day for a single day, is it because I'm over invested? Do I have too many dollars devoted to my SPX trade? And if the answer to that is yes, well then you're learning something about your own risk tolerance. Okay? So what I'm talking about here is defining a process that gives traders a method for deciding to be more aggressive versus being less aggressive. So there's no decision making necessarily that you need to be all in or all out or full on risk trading versus all risk off trading, right? For a lot of us, it's just taking advantage of the probability factors, right? A single close below the 50-day might shift probabilities a little bit, but the moment you immediately recapture the 50-day, the very next day, not just recapturing the 50-day, but recapturing with a hold move very quickly as well, you end up with a different feeling rather quickly, okay? So always have a set of ideas that will lead you to become more defensive versus more aggressive or more offensive, okay? All right, so here in the SPX, some confirmation. We're feeling a little bit better about this. We'll watch the 50-day as we often will, but we're getting a nice start here this morning. Let's check out the NDX. We're up 1.25% here. Very similar action. Lots of lines drawn in here. Let's see. Let me go back to, there we go. That looks like a cleaner chart. So again, close below the 50, hold of horizontal support in some area right here. Right? So again, we did not make a lower low, we made matching lows. Matching lows in the midst of an uptrend are fine. It's the lower lows that we do not like. So here, have we just basically consolidated? Perhaps, right? There's nothing to suggest at this time that we've just, that our trend is breaking here. A couple of things that stand out on the chart for me though in the NDX, I want to use some concepts of RSI, some understanding of what the RSI should be telling us about the strength of this trend. First of all, we know the strength of the trend, right? We're above the 50-day, we're holding the 50-day again. We can anticipate and understand getting some consolidation going on after big moves. And again, this was not small. We talked about this, I think, yesterday. 35% up over the course of 65 sessions. So 3 months, you had a massive 35% move in the NDX, and you're going to undertake some consolidation thereafter. It cannot go straight up. Commonly, if it does go straight up, we're often going to revert rather quickly. So here, the thing that's standing out for me today is the level of the RSI down below, which managed to pull back to what we would say are bullish areas for support confirmation here with the RSI. I'll put my crosshairs down there, and you'll notice if you look at the far right of this level, or the far right of my chart, you'll see that the number it's reflecting is 47, and that puts us in the range of that 45 to 55 midline on the RSI. And remember that when we are in the midst of a trend, the RSI does not have to get to oversold conditions, true oversold conditions at the 30 line, which is what would be considered standard for oversold. In the instance that RSI pulls back to between 45 and 55 in the midst of consolidations like this or finding support, it leads us to a view of bullish behavior on the chart, or at least as it relates to the price action. Momentum has slowed, it's true, okay, but that's what we expect after big moves. So the couple of takeaways, the biggest of which is that while we have lower highs in here, right, this is lower than the last, this one was lower than the prior one, obviously, we have lower highs right now, but we don't have lower lows. Okay, so that's a positive to take away as well. Now, if we can continue higher and take out that last peak, rally into it and move through it, then it looks more like continuation of the existing trend. So we're waiting on that here in the NDX. Okay, let's check out the Russell. Basically, it's been a strong outperformer for us. The Russell digesting, in many cases, higher yields and still pushing higher. My ovals are talking about the 20-day moving average, which has been supportive for much of this move, but you'll notice that a couple of those instances below the 20-day have not broken the true trend here, but rather have given traders their chance to participate. Now, one of the big questions I got in yesterday's survey request was about the various moving averages, because we coaches are all different as to how we approach the market. Some of us coaches are very clear in using very specific moving averages, and you might see a 10-day, you might see a 30-day. Some of you might use following or working with JB. You might find yourself working with whole moving averages. I tend to be a bit more basic in the sense that I want to evaluate the most commonly utilized moving averages, those being the 20-day, the 50-day, and the 200-day moving averages. So while those might be the most commonly used, they're not necessarily the correct ones per se, all right? So part of the process of evaluating trend is to define your own time frame for your trades, which can help you to define which of the moving averages is pertinent, and then B, also recognize that each instrument, stock, exchange traded fund, or even an individual stock, an index, all of them will have a prevailing moving average, a moving average that seems to be supportive or resistant in nature. Now, right now, while we see the 20-day in the Russell has been relatively supportive, right? We've had these deviations, these violations of the 20-day. If you're a trader following the 20-day, you may have found yourself compelled to take action by virtue of the fact that you thought, oh, the 20-day should hold. It's been working all through here. But then we got 1 day below it, 2 days, 3 days. It wasn't until day 4 when we were back up above it. So some traders would say that the 20 was not as good for them on the Russell because it encouraged a pause, or maybe it encouraged them to be a little defensive for a short-term period. So sometimes it's as simple as just playing with the moving average to see which one is going to give you the greatest amount of comfort with it. And here, we have not even come close to the 50-day. I mean, the closest we came, I guess, was this huge day back in mid-June, June 9. We had this big, big day where our range was massive. Our low was 27.95 and our high was 29.21. So we basically had a 130-point swing in the Russell 2000. That's a big move intra-period. And we didn't technically test the 50-day at that time. We didn't touch it per se, but kind of tested it, I guess. So it's a process of discerning. One, is it the moving average that makes the most sense for you, or is it the moving average that the instrument itself is tracking? Which is to say, is it the moving average that the traders who are trading that instrument or that stock are tracking, right? So there's a couple of ways you can go about deciding it, but I recognize that because us coaches, we are all different in approach. What we do here, we're trying to open your eyes to the various ways that you can manage your own trades, manage your trends, and be comfortable with your positioning. It's not easy. Don't let anyone tell you that's an easy process, but building out a process that makes sense to you and is comfortable for you to use and gives you clean and easy decisions to make is probably a process that most traders are going to be pleased with. Eliminating the difficulty of making decisions, giving yourself some rules-based trading ideas, these are the kind of things that can make your process a little easier. Now, when we played with the difference between the 20 and the 50-day, while it's infrequently noted, don't forget you can use any moving average you want. Okay, so I'm going to put the 20 back up, but let's just make one adjustment here. I know that Connie, for example, Connie Hill, likes to use a 30-period moving average from time to time. All right, a 30-period moving average, it's not that much different, is it? Instead of 4 weeks with a 20-day, it's 6 weeks with a 30-day. Now, if you look at what the 30-day looks like here, it's actually been a little bit more consistent for the Russell, hasn't it? So it does not necessarily matter which of the moving averages you choose to work with. But what it does give you is a visual, perhaps, of how the 30 period has only been violated for very brief instances. And when violated for those very brief instances, it was quickly back above. And look at what happened with yesterday's candle. So if you were the user all along, relying on the 30-day for your decision making, well, yesterday's candle is awfully insightful, right? Because we had an open and then a sell down intra-period below that moving average, but closed above it. So we had a beautiful, essentially a validation of this level. Okay, so my white line I could probably push down a little lower. It was, remember, basic technical 101 stuff, resistance through here. What was resistance can then become support, and it did. We rallied, and then we got pushed back to it to test support. Remember, these concepts play out over and over and over again. When they change and when they don't hold is when we need to make note of it. So I hope that was a little bit helpful, at least, in determining the moving average that you want to work with. For traders getting familiar with things off the jump, I think it makes the most sense to fall into comfort with the most commonly used moving averages. And then as you get better and more comfortable yourself, more familiar with charts, more familiar with some of the concepts of technical analysis, then start to play with those moving averages a little bit. But always be thoughtful about recognizing that no moving average is perfect, right? But the reason the moving average is valid is because other traders like yourself are out there monitoring the same stuff that you are. All right. Remember, technical analysis has an influence from what we call self-fulfillment, and that is the validation of price action relative to how all traders are viewing the same thing. So if we are all watching the same patterns, the same charts develop, and we all believe that it's the 30-day moving average that's providing support, well then you're going to be more likely to take action based upon price movement in and around that 30-period moving average. So it takes time, but don't misunderstand that there is a perfect moving average or something like that. That does not exist. I hope that's a little bit helpful in trying to discern really what matters when we're watching the trend. And as always, while we could talk moving averages all we want, it's perfectly fine just to fall back on your standards, everybody, and just recognize that along the way, if the stock or the index is continually making higher highs and higher lows, it can be as simple as monitoring basic support, basic resistance, and looking for higher highs and higher lows. All right, here we've moved off of the Russell 2000 into the semiconductor index. And everything we just discussed with the Russell is applicable to the semis, except not for the 20-period moving average, even though it was for a while the prevailing moving average. Going back to April 2 here when we recaptured it, we only had 1 day below right here, and then we made our ultimate peak here. So if we go back just to April 2 when we recaptured it and held, actually I guess we could say April 1st. Let's go to our low on April 1st. And you had a heck of a rally, 90% from there. Okay, that's a great move. You're going to get some volatility, and we did. We pulled back from that peak to this low about 18%. By no means should not be uncomfortable. And trust me, if you ended up being a buyer on this day, yeah, it would have been uncomfortable to sit for an 18% drawdown to the 50-day. But again, what do we have at the 50-day? We have the bulls mounting a stand. So let's go back to our prior highs. Prior highs were resistance until they weren't, and then that resistance can become support, and that's what we got here in the semis, isn't it? We had a huge candle on that big day, right here, tested and held that ledge. We were just there yesterday. Got a hammer there, tested and held that ledge. Now it's very important that we get a candle like this to hold at the close today for bulls. Bulls need to see that stand they mounted at support yesterday is going to provide a follow through, and that's what we got, right? So you got the close above the high of the low day yesterday, and then not just a follow through day today, everybody, but a gap and go follow through. So now the hope and the bullish view is that not only do we keep the candle green, but we don't invert that candle. What we don't want to see now is that the buying optimism at the open today wanes and flips this candle to look anything remotely close to this one. This is not what we want to see. Okay, so right now, good to go. Happy, we like what we see, and I say good to go, I just mean at this time of the morning in the first 20 minutes of the session, this is exactly what bulls were looking for, a gap following a hold, which is now going to give a little bit of optimism and a little bit of enthusiasm. If we went to the intra-period here, let's use I've got 5-minute bars. The key takeaway here is that we not only gapped, but we gapped aggressively. We gapped through R1. Okay, so over here on the right, everybody, I'm using the pivot point studies. These I have applied only for the current day. This is the mathematical calculation of yesterday's price action. Essentially, this was designed to give institutional traders an understanding of equilibrium price. That is to say, the price at which the index or the stock should trade for the day. And that level, based on yesterday's price action, was down here, the purple line, the true pivot. But if you're utilizing pivot points and you make note of the gap scenario, the fact that we gapped R1, resistance 2, changes the belief of the equilibrium price. So now for the day, the equilibrium price is apt to be R1, or pardon me, R2, I guess it was, since we gapped that level. So that pretty much puts you at the lows of Monday. Okay, so we gapped through those. We've rallied into the highs from Monday. So we've kind of got a short-term range in the semis here built in, don't we? And could we simply find a little bit of profit taking at this level? Absolutely. If we found profit taking and got beaten back, could we find support at the secondary line? Absolutely. But this, if nothing else, gives traders a little bit of a shorter term insight as to where we can get pressure to the upside or pressure to the downside. And it looks to me like those are more or less sandwiched between R2, resistance 2, and resistance 3 up above. And then, of course, one reminder about basic technicals. Remember, when we move through an area of resistance, if we do so with any conviction, then we can really move, right? You take the lid off of price action, we often will see some enthusiasm or momentum-based moves. So it's not to say that I know what's coming here, because I don't. But if it rejected this level, well, then traders might start to be, oh, I'm going to take a little bit off because I bought yesterday in late session or whatever. I've got a great 5% pop. Let's go ahead and pull a little off. Or the trader says, let's wait and let's see if it breaks. If it breaks to the upside and gains momentum, then I'm going to deploy new money into that trade for the hope of a momentum-based move quickly. As always, kind of thinking about this in advance, giving yourself a little bit of a plan. Super important to the process, right? So make sure you're doing that, giving yourself some steps to take if you want to participate in a given move. Okay, so there's a quick look at our biggest of indices and our semiconductors. The commentary we got late yesterday from the broad market, we also heard that maybe things aren't as negative as we thought with regard to the Iran conflict. The president saying late last night that he got a call from Iran to discuss the situation. I don't know if that's true or not, but let's peek in on what's happening with oil. We're going to use the futures symbol for oil here, everybody. Remember, we're not advocates for futures trading. We're just using this for an understanding of the price of futures or the price of oil. And here, what's interesting to me is the rejection at the 20-day moving average here. The confluence of the 20 and the 200. So you all know we broke this back in late May. We used the supporting trend line was the support for a minute, then it became resistance, right? And now we've been resistant against the orange 20-day simple moving average. So a lot of traders are eyeballing it for now to see if we can get above the 20 period. As much as we don't like necessarily big bounces in oil, boy, it looks like a pretty clean rejection, at least at the moment. If you're looking right now for to legitimize the rejection, the next scenario, basic technicals suggest one of two things is going to happen. We're either going to continue the rejection at the 20-200 confluence like we have it right now, but we don't know directionally until we close below yesterday's low. If we close below yesterday's low, then we will have a close below the low of a high day after a brief rally. And this would be brief, right? I mean, this was just last Thursday. So Thursday, Monday, Tuesday, Wednesday, and then today. So if yesterday is the highest we see oil trade, well, then a close below yesterday's high would at least validate rejection in the short run. If it's a fully inside day, it becomes a wait and see for some traders, right? But we know that the movement lower in oil has been beneficial to the broader markets. It's been a disinflationary process, as is often the case. So we like that as it relates to oil. We'll see what happens here. We got a good bounce in energy as a result of that yesterday or over the last day or two. But again, while we're above the 20-day, I find it interesting here. I'm going to eliminate this line of what was horizontal support. What I find interesting is that we got into the gap in here and then essentially created yesterday Thank you for your patience, everybody. My apologies. I gotta say, I don't know. Yesterday I was in the office and it happened. Today I'm not in the office and it happened. I don't know. I feel like it doesn't matter where I'm going to host from. I'm going to experience some technical difficulties one way or the other. Okay, we're talking about energy here and utilizing our concept of the potential for close below the low of the high day. And that's what we're looking at right now with today's action on energy, right? So that's what we're kind of monitoring here. Again, as it relates to oil, you know, even if you thought that energy or that oil was going to stay bullish in nature, you've got a couple of reasons for consideration if you wanted to be that trader. But if today closes with this candle like it is, or maybe even lower, closer towards the 20-day moving average, just know that it would be below yesterday's low, and that could signal things shifting a little bit or pulling back even still. Doesn't mean that that we are looking at a scenario in which we're going to get huge moves one way or the other in energy, but it's notable that we're already trading below yesterday's low. The interesting thing to me is the move we've seen in energy all year has been really strong. We know that it was up like, what did we say, about 40% at one point on a year-to-date basis, and now we reside up about, let's find out. I think we're up about 16, 17% year-to-date. Oh, 19% year-to-date. There you go. So, you know, even still, energy has been the leader on a year-to-date basis. That's kind of interesting, isn't it? In fact, this is a good chance. Another question I got, everybody, from the survey yesterday was about relative strength, about understanding sector rotations, movement between the various groups, and how to apply that process on a day-to-day basis. And so I thought we could speak about that for just a moment or two here, utilizing, of course, my watch list on the left, but my market watch list here in the center, where I've got the variations of percent change. So the reason that I like this is that I can use this for a period of time consistent with whichever trade window I want to participate in. So over the last 5 days, where has our leadership been? It's been in energy and it's been in tech. It's been in energy because of the oil bounce, and it's been in tech because of the deeper pullback over a longer window of time. Even though tech is still up on a 20-day basis, 4%, a lot of that tech pullback has occurred over the last month even still. Now, we're getting a nice bounce here, so one of the thought processes that I want to give encouragement for consideration is to always kind of start your morning broadly, right? You start with your indices, you take a look and see what's moving around, but when you come into this space here, using these percent changes or even relative strength on a 5-day, relative strength on a 21, on a 63-day basis, and just some reminders, 5-day because it's a 1-week basis, 21 because that's a 1-month basis, and then 63 because that's a 3-month basis. Okay, so that gives you a little bit of an understanding for time frame relative to these individual groups. So the thing that stands out to me, first of all, is that on a year-to-date basis, the only thing in the red year-to-date is discretionary. That's it. And there have been windows of time when if you were long energy in the midst of their strong move, well, then you were doing exceptionally well. Even if you held all energy during the rally and on the pullback, you're still doing well on a year-to-date basis. Now, if you're the trader who's more active and you took advantage of the energy move, and then when energy's momentum started to wane, you started to apply that money to the lagger areas of the market within your portfolio, well, you probably went ahead and did well, right? Because if you took money off when energy was up 40%, you pulled some of that off the table, kept some of it, but the stuff you pulled off, you moved to other lagging areas in the shorter term. You probably have seen some of that movement benefit you. So let's talk about a couple of the spaces. If you've been coming to this class for the better part of this year, you know that we've been talking about the impressive movements we've seen in healthcare and the impressive movements we've seen in financials. And we can use these charts to help us know when we might start needing to be paying more attention. And I feel like even though we know now, it's always easy in hindsight when we look back in time, but the big thing for healthcare, everybody, was when we broke and retested our short-term resistance. And so, I'm going to draw a line through here in healthcare and just highlight this price action. Okay, we made this big drop from resistance, and you could have drawn in a bit of a downtrend line, kind of like so. All right, and we had an area like this that looked supportive, except for that one single candle. Now, again, I know we are going back in time, and it is so easy to do this when I've got the benefit of time having passed. But when you've seen these things play out many times in the wild, then it becomes easier to recognize, and it becomes easier to participate, or at least gives some reason for why you would look to participate. So we had a doji day at an ultimate low. This looks like an island unto itself, doesn't it? Relative to everything else that was going on, this level is all by itself. So we have this little island reversal, essentially. If you were looking for reasons to believe that this was a false breakdown, first would be the fact that it's a doji below that level of support. The second would be that we had a divergence with the RSI. So here, a much higher RSI versus the last time that we made a low. So this low back in late March, RSI was here, and then this low, RSI was higher. So we had a bullish divergence. Then we came back and had to test it once more, but came off of it again and established a new uptrend. Now, right now it looks like the 20-day would be a decent area for management of trend, right? But it's going to be slow for a lot of you traders because the distance between where we are at 1895 and where we could be at the 20-day, 1825, not everybody's going to want to give up 70 points to find support, okay? So maybe it's a 10-day moving average here. Well, there's something we just learned, isn't it? I mean, a pullback to the 10-day, that's a strong trend if it can hold that, all right? The speedier the moving average that gets maintained, the more momentum you might have to work with. So here, if you were the trader who said, boy, I would like to expose money to healthcare, when would you be most comfortable doing so? Let's change this back to a 50-day. If you're like a lot of traders, you're not probably finding a good reason in the moment to try and participate based on that candle right there, right? Probably not. But if you're the more patient trader, you might be the believer in, we took out the 50-day to the upside, and then look at that, we got a test of the 50-day right here. That could give traders reasons to believe. The movement through the prior high right here, and then the throwback move, which was the throwback to the 50 the second time right here. Whoops. No, make that an oval. There we go. Right here. So this could have been the instance where a trader says, yeah, I'm feeling better about it right here. And we're above the 50-day. And then we got a hold move, a little more clean. Everybody look, even if you said, I can't buy on a red day, even though we're testing the 50-day, I need confirmation. You may have had it the next day, but some would have waited for the follow-through day. Even if you were the buyer right here at the high, you're up 6% to today's price level. Okay, just based on a little bit more of a confirmatory reason for taking action at that point. And so I just wanted to bring this to the table as the reminder of process, right? We know we had a downtrend. Downtrends are followed by uptrends, and if we can participate the earlier the move, well, then the more opportunity we might have. So remember that even though you've had multiple instances along the way, there's nothing to suggest you, at any point you would have had to have been fully participating, right? You could have easily participated just a little bit to your comfort and then see what happens. And truly finding what you determine to be true risk, which is to say how many dollars you should have invested at any one moment in time. I feel like that's the most important detail for us. Regardless of your comfort and familiarity with technical analysis, the bigger aspect is likely tied to how many dollars you're putting on any of these trades. And if you find yourself working with positions and incapable of sticking with the trade, what it's like, even though the trend hasn't broken in any scenario, then the likelihood is you're overdoing your position size. So just recognize that and see if you could find yourself a little more comfort from how you're positioning. Another group that's working really well of late is financials. If you were part of this class, you know that we've been talking about financials since this instance. Since the break of the downtrend. We had a beautiful downtrending channel. I say beautiful in the sense that it was very clean, right? And then we broke out here. We broke out with this gap, caught the 50-day, had a huge candle where we opened really low, below the 50, closed above it. What have we done since? Validated horizontal support. So one more reminder about trend breaks. It is not at all uncommon for intra-period breaks of the trending moving average and to find horizontal support. And that's exactly what happened here. So we found horizontal support intra-period, and then we got a big gap up the next day. If you were looking for signals on financials, one signal would have been the one I've already mentioned, of course, the break through the 50-day and then the test and hold. Number two would have been the break of the downtrend line after the break of the pop and hold. All right. And if you chose to buy here on the big candle day, well, we haven't been lower since, have we? Now, if we zoom in on financials, what we got here was that lengthy consolidation. What you got here was a speedy one, speedy bull flag, speedy relative to the last one. This one was about 2 weeks, and this one instead was April 8th through June 4th, almost 2 months. Okay, so we love it when, as bullish traders, the consolidations expedite. That tells us momentum is at play. So we had a lengthy consolidation followed by a speedier one, and right now what you've built is a very quick bull flag, and I say very quick if today's candle is followed through tomorrow with a move through yesterday's high. And then it's going to look like confirmatory action yet again. So, I realize that a lot of this conversation today is speaking to the need for us as traders to develop this process. I'm hopeful that as we evaluated some of these areas of the market that have been showing improvement, that what we're getting is evidence that we can work with, right? We have seen this evidence coming through over the better part of the last 3, 4, 5 months. And the takeaway here, I believe, is that while almost all bullish traders really enjoy technology for a multitude of reasons, technology is not the only space in the market. And you will find opportunities in every sector where you're willing to search, okay? Now, if you're looking for another class that takes a similar approach or takes this approach and puts it into action, check me out on Tuesday afternoons. I host a class called Building a Stock Portfolio, and we stress and strive to work with stocks that are already in uptrends, that are building those longer term trends so that we can participate and hold those positions for as long as possible. That is our goal, is to buy this position, manage it along the way, let it do its thing, elevate, raise stop orders, our exit strategies as a means of managing our own risk, and we talk consistently about the various moving averages that could be pertinent for the stocks that we're looking at. There are examples. So I'm hopeful that this conversation was helpful for all of you. Additionally, if you're looking for more, check out some of the other classes here. Obviously, we've got many hours available to you here on the channel. But if you wanted to check out the Building a Stock Portfolio, I think it's a good follow-up to today's conversation around proper moving averages, trend management, and trade management as well. So with that, thanks to both Ben Watson and Cameron May in the chat. I know we had Cameron stepping in for Ben as he had to do a hit today. So I appreciate all of you being here. Make sure you're following us on X. If the conversation was helpful for you today, you can hit that thumbs up below for me. I get this reviewed into our archive. It'll be available for playback later on. And with that, I'll just thank you all for being here. Tomorrow we do have Trader Talk at Market Open. It is ETF Friday, and I'll remind you, of course, ETF Friday is not an archive session, so make sure you are there live. And of course, thank you, Ben. Don't forget to subscribe to the channel, everybody. Be part of the community here. Have a great morning. We'll see you all again real soon.